Welcome to the Stocks Pulse, where we bring you fascinating stories of innovation, strategy, and success.
Starting with our quarter, we are very pleased with our results as we continue to deliver on our strategy to return to strong growth in FY25. I will share some highlights from the quarter and then turn to an update on new developments since we were together in December in our federal business and the current environment more broadly. Our clients continue to prioritize large-scale transformations, and we are their reinvention partner of choice, as reflected in our bookings of $20.9 billion, including 32 clients with quarterly bookings greater than $100 million. We grew 8.5% in local currency with revenue of $16.7 billion at the top end of our guided range, and we continue to take market share on a rolling four-quarter basis against our basket of our closest global publicly traded competitors, which is how we calculate market share. We had another milestone quarter in Gen AI with $1.4 billion in new bookings and approximately $600 million in revenue. Operating margin contracted 20 basis points compared to adjusted operating margin last year, and we delivered EPS growth of 2% over Q2 FY24 adjusted EPS. We continue to invest significantly in our business to drive additional growth in highly strategic areas, with over $250 million deployed primarily across 6 strategic acquisitions, and we invested in our people with approximately 15 million training hours this quarter, designed to help us bring the latest in solutions and technology to our clients, provide our people with marketable skills, and reinvent our services using Gen AI. We increased our data and AI workforce to approximately 72,000, continuing progress against our goal of 80,000 by the end of FY 2026. We continue to invest in creating and maintaining thriving communities, which is a component of our long-term growth strategy. This quarter in India, we launched a transformative hospitality skilling program in collaboration with our client, Marriott International, which prepares disadvantaged youth for entry-level jobs in the hospitality sector, including training for digital skills. Because we help our clients execute on some of their most important priorities, and we need to attract and retain the best people, recognition of Accenture as an ethical and admired company is critical for our clients' confidence and to attract these great talent. We are pleased that we have been recognized by Ethisphere as one of the world's most ethical companies for the 18th year in a row, and for the 3rd consecutive year, we ranked number 1 in our industry and among the top 5 overall on Just Capital's America's Most Just Companies. In addition, thanks to our clients, partners, and the wider business community, we earned the number 1 position in our industry for the 12th year in a row and number 30 overall, our highest to date, on Fortune's list of the world's most admired companies. Now for 2 updates. First, Accenture Federal Services. Federal represented approximately 8% of our global revenue and 16% of our America's revenue in FY24. As you know, the new administration has a clear goal to run the federal government more efficiently. During this process, many new procurement actions have slowed, which is negatively impacting our sales and revenue. In addition, recently, the General Service Administration has instructed all federal agencies to review their contracts with the top 10 highest-paid consulting firms contracting with the U.S. government, which includes Accenture Federal Services. The GSA's guidance was to terminate contracts that are not deemed mission-critical by the relevant federal agencies. While we continue to believe our work for federal clients is mission-critical, we anticipate ongoing uncertainty as the government's priorities evolve and these assessments unfold. Based on our significant experience across federal and commercial clients, we see major opportunities over time for us to help consolidate, modernize, and reinvent the federal government to drive a whole new level of efficiency. Second, in recent weeks, we are seeing an elevated level of what was already significant uncertainty in the global economic and geopolitical environment, marking a shift from our first quarter FY25 earnings report in December. At the same time, we believe the fundamentals of our industry remain strong, and we are very well positioned with our clients because all strategies continue to lead to reinvention through new ways of working, tech, data, and AI. We are confident in executing our strategy to help clients reinvent. As you would expect, we are laser-focused on bringing tremendous value to our clients. Our strengths lie in our agility as the market we operate in changes, utilizing our deep client and ecosystem relationships and our leading position in Gen AI and technology more broadly. We are also well diversified across markets, industries, and types of work, which enables us to continue to lead in a changing market context as we have done before. Over to you, Angie.
Thank you, Julie, and thanks to all of you for taking the time to join us on today's call. We were very pleased with our results in the second quarter, particularly our continued strong top-line growth, which was once again broad-based across geographic markets, industry groups, and consulting and managed services. Let me begin by summarizing a few highlights from the quarter. Revenues grew 8.5% in local currency, which was at the top end of our guided range, with 9 of our 13 industries growing high single digit or higher. And we continue to take market share. We delivered EPS in the quarter of $2.82, reflecting 2% growth over adjusted EPS last year. Operating margin of 13.5% for the quarter decreased 20 basis points compared to adjusted Q2 results last year and includes significant investments in our people and our business. Finally, we delivered free cash flow of $2.7 billion and returned $2.4 billion to shareholders through repurchases and dividends. In the first half of the year, we have invested almost $500 million, primarily attributed to 11 acquisitions. With those high-level comments, let me turn to some of the details, starting with new bookings. New bookings were $20.9 billion for the quarter, a 3% decrease in U.S. dollars and flat in local currency, with an overall book-to-bill of 1.3. Consulting bookings were $10.5 billion with a book-to-bill of 1.3. Managed services bookings were $10.4 billion with a book-to-bill of 1.2. Turning now to revenues. Revenues for the quarter were $16.7 billion, a 5% increase in U.S. dollars and 8.5% in local currency. The foreign exchange impact for the quarter was approximately negative 3% compared with the negative 2.5% estimate provided last quarter. Consulting revenues for the quarter were $8.3 billion, at 3% in U.S. dollars and 6% in local currency. Managed services revenue were $8.4 billion, up 8% in U.S. dollars and 11% in local currency, driven by double-digit growth in technology managed services, which includes application managed services and infrastructure managed services, and high single-digit growth in operations. Turning to our geographic markets. In Americas, revenues grew 11% in local currency. Growth was led by banking and capital markets, industrial, health, and consumer goods, retail, and travel services. Revenue growth was driven by the United States. In EMEA, we delivered 8% growth in local currency, led by growth in public service, life sciences, and consumer goods, retail, and travel services. Revenue growth was driven by the United Kingdom. In Asia Pacific, revenue grew 1% in local currency, driven by growth in insurance and utilities, partially offset by a decline in chemicals and natural resources. Revenue growth was led by Japan, partially offset by a decline in Singapore. Moving down the income statement. Gross margin for the quarter was 29.9% compared to 30.9% for the second quarter last year. Sales and marketing expense for the quarter was 10.1% compared with 10.3% for the second quarter last year. General and administrative expense was 6.3% compared to 6.9% for the same quarter last year. Before I continue, I want to note that in Q2 of last year, we recorded $115 million in costs associated with our business optimization actions, which decreased operating margin by 70 basis points and EPS by 14 cents. The following comparisons exclude these impacts and reflect adjusted results. Operating income was $2.2 billion in the second quarter, reflecting a 13.5% operating margin, a 20 basis point decrease from adjusted operating margin in Q2 of last year. Our effective tax rate for the quarter was 20.4%, compared with an adjusted effective tax rate of 18.8% for the second quarter last year. Diluted earnings per share were $2.82, compared with adjusted diluted EPS of $2.77 in the second quarter last year, reflecting 2% growth. Days services outstanding were 48 days compared to 50 days last quarter and 43 days in the second quarter of last year. Free cash flow for the quarter was $2.7 billion, resulting from cash generated by operating activities of $2.9 billion, net of property and equipment additions of $171 million. Our cash balance at February 28th was $8.5 billion, compared with $5 billion at the end of at August 31st. With regard to our ongoing objective to return cash to shareholders, in the second quarter, we repurchased or redeemed 4 million shares for $1.4 billion at an average price of $361.16 per share. As of February 28th, we had approximately $5 billion of share repurchase authority remaining. Also in February, we paid a quarterly cash dividend of $1.48 per share for a total of $929 million. This represented a 15% increase over last year. And our board of directors declared a quarterly cash dividend of $1.48 per share to be paid on May 15th, a 15% increase over last year. And now, let me turn it back to Julie.
Thank you, Angie. Starting with the demand environment, our clients continue to be focused on reinvention, and Gen AI is a catalyst for reinvention. They're focused on building the digital core, with more AI being built in, which is driving our growth, and on areas such as the customer and core operations, including supply chain and Industry X. For our clients, the twin themes of achieving both cost efficiency and growth continue. The number of clients embracing Gen AI is increasing significantly, and we are starting to see some tangible examples of scale in data and AI. We are partnering with Telstra, Australia's leading telecommunications company, to create a new joint venture to accelerate its data and AI roadmap and fast-track the business into a new era of AI-driven reinvention. Through the joint venture, we will work together to simplify and modernize their data systems and set up a comprehensive AI foundation to deploy advanced AI solutions across their organization. Value-driving AI use cases have been identified across the business that are suitable for scaling and will enhance network resilience, deliver seamless connectivity, and better customer experience. Using our AI refinery platform, we will reimagine business processes by implementing agentic AI. Specialized AI tools will support their employees to work smarter and faster, and teams to operate more efficiently and effectively. In addition, we will help evolve Telstra's Data and AI Academy, a company-wide upskilling initiative leveraging our learning and development programs, helping to build data and AI fluency and future critical skills across its workforce. Building on Telstra's globally leading responsible AI practices, the JV is designed to sustain and improve on this by identifying and mitigating AI risks while building trust and adoption as it scales AI across the organization. This partnership with Telstra illustrates to clients that there are creative ways to accelerate their own use of data and AI. Clients in Australia from banking, retail, and utilities are working with us to design their own innovative ways to jumpstart their reinvention with data and AI. We continue to see our clients building their digital core as a foundation for reinvention and increasingly asking us to incorporate emerging technologies like AI as well as data into this work. Cloud saw double-digit growth this quarter, and security had very strong double-digit growth. We are working together with a multinational food processing company to help reinvent themselves as a data-driven organization, revolutionizing their enterprise. This includes the end-to-end supply chain and frontline sales function to support rapid growth. Our unique partnership model uses our library of AI and Gen AI assets to quickly deliver productivity, with the potential of generating over $500 million in value to self-fund their reinvention. The savings are reinvested into an ongoing build-out of a robust digital core, which becomes the foundation to support and enable any new technologies, processes, or systems the company may adopt in the future. For example, the company is using Gen AI to forecast inventory risks and generate next best action recommendations, saving them millions of dollars annually. If excess inventory on a product is selling slower than expected in a region, Gen AI tools proactively prompt a promotional sale or halt production before the inventory results in a margin loss. In another instance, an AI-based communication platform was deployed that eliminates up to 5 different language barriers between supervisors and frontline workers and plants, reducing costly errors from miscommunications and delays. With many households having at least one of their products, this company's commitment to ongoing transformation will position them to continue to build, design, and run a future-ready enterprise, rethink work, and drive innovation. We are helping one of the world's largest auto manufacturers modernize their security operations to protect the company's critical IT systems and stay ahead of the rapidly evolving security landscape. We will implement a modern threat detection and response platform that will enable the company to integrate its data across the enterprise, identifying cyber threats and responding to incidents faster. We are building a new Gen AI security engine on Accenture's My Security platform, which will help automate cloud migration tasks, moving the threat detection capability from the legacy platform to the new one without interruption. This is expected to increase the company's operational excellence, enhance cyber resiliency, increase risk visibility, and drive a significant improvement in efficiency. With the new platform, the company will be able to better safeguard digital assets, including information critical to automotive design and manufacturing. This collaboration will help better protect the company, its partners, and customers, setting the stage for advanced AI, smart manufacturing, and increased innovation. To capture the value of technologies like generative AI, companies need a digital core, and now, to stay ahead and truly scale AI, companies also need what we call a cognitive digital brain, an always-on and always-learning system, as we shared in our Tech Vision 2025. Our industry expertise is critical to building the digital core and digital brain. A deep knowledge of the processes today and how they can be reinvented for tomorrow is key. Our proven track record of digital transformation and our ability to bring experience in strategy, consulting, industry, process, and technology services, and decades of experience in managed services for our clients allows us to truly reinvent using AI, including digital agents, to create transformational value at scale. We are deepening our partnership with Repsol, a leading multi-energy company and a client for more than a decade, to advance its digital program and scale agentic AI, reinventing key business operations to drive sustainable growth. Over the past 3 years, we have built a secure cloud-based digital core with a unified data foundation. Now, we will use our AI refinery platform to deploy customized AI agents across functions such as planning, forecasting, and customer service, making processes more dynamic and less complex. Employees will be able to work more efficiently and provide customers with accurate, personalized products and services. For example, AI agents can analyze available data to offer timely and relevant bundled energy solutions, enhancing Repsol's position as an integrated provider. We will upskill employees in AI and digital technologies through an expanded training program to support adoption. We are also exploring digital twins and robotic solutions to enhance planned maintenance and other tasks in industrial and logistics centers. Repsol is positioning itself as an early adopter of AI in the energy sector, increasing efficiency, boosting productivity, and promoting new ways of working to better serve customers. The transformation and digitization of manufacturing is an important area of growth, and Industry X grew high single digits this quarter. We are working with Kion, a global leader in supply chain solutions, to use AI-powered digital twins to create smarter, safer, and more adaptable warehouses that can evolve with the world around them and handle nearly any supply chain challenge, marking the next digital frontier. Picture a busy warehouse during peak shopping season. Workers navigating narrow aisles and conveyor belts, forklifts loading and unloading freight. Now imagine robots working seamlessly with human teams to fulfill orders faster and more safely. We are making this a reality by creating digital versions of physical assets such as conveyors and forklifts, and integrating autonomous robots with human workers on an AI-driven platform that accurately simulates millions of complex factory processes to help ensure safety and avoid disruptions before robots hit the factory floor. We are also predicting and adapting to real-world challenges as they happen, such as how events like Black Friday sales or a product going viral might affect warehouse operations, adjusting robot brains in real time. With these advancements, warehouse workers' responsibilities will evolve as they work alongside AI systems, making them more desirable candidates for higher skilled roles. Song grew double digits this quarter as more clients seek to reinvent customer and experience. We have the unique ability to integrate creative data and AI, tech, and strategy while leveraging our industry and operations expertise to unlock marketing and sales as a growth enabler for our clients while delivering efficiencies. We are partnering with a multinational conglomerate in the communications industry to streamline and optimize their media strategy and operations for their mobile division. We've implemented a new digital platform with a unified data foundation, which will provide transparency and real-time access to expedite campaign precision. The company will also reduce the number of media agencies to a single partner, Accenture Song, to maximize media spend outcomes. Accenture's marketing operations managed services will leverage automation and AI to increase efficiencies in manual routine tasks, which will allow employees to focus on more strategic work. These changes will also allow the company to shift from focusing solely on media-related data to incorporating broader insights to make more strategic and informed decisions that benefit the entire company, such as predicting customer content preferences, which can drive more efficient media placement and sales. Talent continues to be at the top of the agenda for CEOs and governments, and reinvention requires working in new ways and the development of new skills. LearnVantage positions us to be able to help clients develop talent and skills to drive future growth. Our clients are using LearnVantage to strengthen learning development, turbocharging the learner's experience. For example, we are bridging the skills gap and creating certification pathways for learners using LearnVantage in the Kingdom of Saudi Arabia. This will fast-track their careers and support their adoption of Gen AI. And a big box retailer has accelerated learning opportunities for entry-level to highly technical skill sets, deepened understanding of current industry skills needs by role, and empowered employees with guided learning based on the skills they need for their role. Finally, a look at how we continue to execute on our goal to strategically deploy $2 to $3 billion in B&A this fiscal year. We are investing in our Industry X and supply chain capabilities with our acquisitions this quarter of AOX and Staufen AG in Germany. We also acquired IQT Group in Italy, a managed services provider which will help utility providers build and modernize integrated electricity and water networks. To continue to lead in Gen AI, we acquired Halfspace in Denmark to help our clients in the Nordics region leverage and scale AI to make better, more informed decisions faster. And to enable us to scale faster in financial services, we acquired Altus Consulting in the UK, a leader in consulting and digital transformation. Also this quarter, we purchased a digital twin technology platform for banks from Percipient, a Singapore-based fintech company with deep expertise in banking technology transformation. Back to you, Angie.
Thanks, Julie. Before I get into the details of our outlook, as Julie mentioned, we have seen an elevated level of uncertainty, including in our federal business. Because this change is very recent, our revenue guidance range for both Q3 and the full year reflects our best view based upon what we see today, which may evolve differently from our estimates and assumptions. With that said, let me turn now to the business outlook. For the third quarter of fiscal 25, we expect revenues to be in the range of $16.9 to $17.5 billion. This assumes the impact of FX will be about negative 0.5% compared to the third quarter of fiscal 24 and reflects an estimated 3 to 7% growth in local currency. For the full fiscal year 25, based upon how the rates have been trending over the last few weeks, we continue to assume the impact of FX on our results in U.S. dollars will be approximately negative 0.5% compared to fiscal 24. For the full fiscal 25, we now expect our revenue to be in the range of 5% to 7% growth in local currency over fiscal 24. We continue to expect an inorganic contribution of a bit more than 3%, with about 4% in the first half and about 2% in the second half. And we now expect to invest about $2 to $3 billion in acquisitions this fiscal year. For operating margin, we now expect fiscal year 25 to be 15.6 to 15.7%, a 10 to 20 basis point expansion over adjusted fiscal 24 results. We continue to expect our annual effective tax rate to be in the range of 22.5% to 24.5%. This compares to an adjusted effective tax rate of 23.6% in fiscal 24. We now expect our full-year diluted earnings per share for fiscal 25 to be in the range of $12.55 to $12.79, or 5 to 7% growth over adjusted fiscal 24 results. For the full fiscal 25, we continue to expect operating cash flow in the range of $9.4 to $10.1 billion, property and equipment additions to be approximately $600 million, and free cash flow to be in the range of $8.8 to $9.5 billion. Our free cash flow guidance continues to reflect a free cash flow to net income ratio of 1.1 to 1.2. Finally, we continue to expect to return at least $8.3 billion through dividends and share repurchases as we remain committed to returning a substantial portion of our cash to shareholders. As we move into the second half of the year, we remain laser focused on managing our business with rigor and discipline. With that, let's